I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome back to the show, Bob.
Yeah, Jim, good to be with you on this interesting week in the markets.
What has made it so interesting?
Well, it's the positiveness out there. You saw the other day the University of Michigan consumer confidence number came out, and it was a huge, this was for October, and it was a huge jump from the previous month. I can't remember what it was, but it was written up as huge. And then you've got, and perhaps even this turned to positiveness, and hope might have even helped with the Trump win there. And then you now have a pro-business administration getting ready to be in government. And I'm trying to think back to the last time you had a pro-business administration.
Bill Clinton.
I guess the best would have been back in the 1920s when it was tolerant of business. So this is quite extraordinary. But we should sort of remind ourselves that governments don't move as quickly as ideas do, and perhaps it'll take a while to, one, slow down the incredible expansion of government that was being done by the previous administration, with rules and regulations being added daily, hourly. It was monstrous. And so it's a big change from where Obama, who is a fan of Saul Alinsky, when Alinsky's rules for radicals included the way to destroy the U.S. middle classes. And that was through overwhelming the welfare state through community organization, and this, of course, is what was being conducted. And maybe the public may not have been too sophisticated about it, but they knew that something wasn't going right, and so the vote was a no against what had been going on, and it was then, let's give a non-politician a chance. And the few pieces I've written were that the popular uprising is the vehicle of change. Trump happens to be the leader, and so he will have to stay within the concepts that this popular uprising is focused on, and he strays too far off, they will know. So anyways, what's this going to do to the markets? Well, what it has done is popped up the senior indexes, which continue to make new highs. The broad NYSE composite, the NYA, is not yet to new highs. And what depth is there in this? It's starting to get a little overbought now. And sure, I think that the transition from the attempt to build and extend a welfare state is going to be a terrific change to being a pro-business administration, but it'll be slow to come in. So we go back to our usual technicals. Let's just look at the overboughts or oversolds and move on there, and keep an eye on the credit markets, which the thrust to curve steepening, that's the yield curve, which is the difference between short rates and long rates, going into the election was just fabulous, 2 weeks of it. And that then drove the bank stocks up because bank stocks like steepening curve, and now this is sort of taking a pause for a bit here, and we'll see what happens in that one. The other one is the credit spreads, which is the difference between high-grade and low-grade bonds, and now they got trashed into January, February, and severely trashed as crude oil was getting crashed as well. And then there's been a fabulous rebound. The credit spreads have just come a huge long way and have registered some technical excesses a few weeks ago. Technical excesses. So what we're looking at here now is the credit spreads are beginning to try and reverse trend. They haven't reached yet. They've it got down to 11.06, and now it's coming back to 39, but it's beginning to try and change trend. And we watch this one very closely because in the past, like in 2008, one of the things that really pushed off that liquidity problem was the yield curve or the credit spreads widening. And then in 2007, that was the early bird on it when that one was really good because in May, the curve reversed to steepening, which said, hey, contraction is possible. And then in that June is when the credit spreads turned to widening and said, watch out. And so we watch this very closely. It's been reliable. And as we say, on the credit spreads themselves, we're going to give it a few weeks in here. And if the turn actually comes in and we get the critical breakout, we'll advise our readers on that because there'd be some good trading opportunities.
Gold has nosedived lately. What's the future for that?
This is a difficult one, Jim. The gold bugs got, of course, really excited on the rally early in the year and then went back to their old mode that it's the evil Fed. And I agree with it, that the Fed is evil. But the Fed cannot always depreciate the dollar at will. And there's where the central bankers are wrong, and then those gold bugs who hate the central bankers, they're wrong too. Because the Fed cannot depreciate at will. And this, of course, is the whole thesis on the gold bug side, is the Fed was going to drive the dollar to zero and gold will go to 10,000. Well, there's absolutely no rational way that one can come up with those numbers. So we look at the sector. What you have here is that in a post-bubble contraction, which we're in because the big bubble blew out in 2007, is that the senior currency becomes chronically firm relative to most other currencies and most commodities for most of the time, which has been happening. And 2 weeks ago, or a few weeks ago, the dollar index, the DX, started its move, and it needed to break above 100, 0.65, and then it's made it to 101 and change. So it's got the breakout. There is some overhead resistance at the 102, in the 102 to 103 level, but ultimately our target is around 112. And this would be most upsetting to the financial markets because most everything is based upon currency depreciation, asset inflation and currency depreciation. So this is where, of course, why gold and silver would not be expected to perform too much. Our view earlier in the year was when we were looking for a new bull market in the precious metal sector was that the gold and silver stocks would be the place to be. That's where you'd get the big action, which we did get. And we continue to monitor the gold market for what the real price of gold is doing. And that's, you can do it any number of ways. An easy way is just deflate it by the producer price index. And it has been improving since last December, I guess it was. And if that continues to improve, and I don't see why it wouldn't, then that is a proxy for improving profit margins within the gold mining industry. Just imagine that, say, with the gold bugs forecast works out and gold goes to 5,000, who's to say that crude oil doesn't go from $50 to 5,000, you know? Then the energy costs of gold mining would go up, and it's not, you may have gold at 5,000, but it may not be profitable for the gold miners. So our way of looking at it is that people should own some gold sort of as insurance, but if you're in U.S. dollars, don't try and imagine that you'll make some money out of it. But on the other hand, the gold shares is where money will make, so investors will be looking at gold shares, looking for continued improvement in earnings. Now, of course, what happened is into July, the action became very speculative, and our technical tools noted that, and the advice was that a significant correction in the gold sector would follow. My colleague had a target of, for the gold stocks, maybe 20% plus decline, and it turned out to be more of that. And what you had was a low a few weeks ago, a rebound, and then the view has been is that low for gold stocks needs to be tested. It is. As a matter of fact, it's slightly lower than a few weeks ago, which is concerning. But what we want to look at now is what got us into the market in Christmas a year ago, was that the gold shares had begun to outperform the bullion price. So we want to look at that. We also would want to look at silver beginning to outperform gold. So there's a few of those little ratios that one would look at to either reaccumulate gold stocks or just add to positions in here. And we will then, of course, advise on that one when that opportunity comes along.
We'll have more of Bob Hoye right after the break.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Bob Hoye. Bob, OPEC is going to hold its meeting on the 30th. They're talking about freezing production, maybe cutting it back. Any hope for oil prices coming out of that?
Well, people shouldn't even report on OPEC. It's just another four-letter word, because they don't have the power they think they have. We're into a new pricing regime for crude oil prices. They had to follow the huge price collapse in natural gas of a few years ago. Then you've had a technological revolution with U.S. Leading on fracking, and as a matter of fact, there was one came out last week about a new field in the Permian Basin. Can't remember what they called it, but this thing is huge. It's bigger than any tight reservoir discovered so far. It is. So the industry has changed, and as far as the oil stocks go, is that there's far too many institutions that are content to own the oil stocks, wagering on further distress in the Middle East. And that, of course, has traditionally popped the price of crude oil up. And, of course, that's not going to happen anymore. You'll get some brief moves from time to time, but what we're looking at on crude oil now is it looks like the seasonal decline is coming in, whereby you can go down to a pretty good low towards into January. And that worked for us last year very well. So one would then use our tools to look for an oversold in crude, and look for an oversold in the oil patch stocks, there'll be a good trade out there, as there was earlier in this year. So, but as for the long term on the sector, the price of crude oil will be trending down for years and years and years. And it's just the reality of the marketplace. The producers are not getting the price they want, so they produce more. It's the same thing as in farmers with grains. When you're in a weak price regime, it's called planting from fence post to fence post and reinforcing low prices. So here we are. The oil sector around the world will be the equivalent of planting from fence post to fence post, trying to produce as much as possible to continue their revenues, and there's nothing anybody can do about it. So let's just leave the OPEC guys to stew in their own juice.
Bob, what's behind this big pop in the price of copper?
Oh, yeah. That one, it caught us completely offside. We're kind of looking at the seasonal low for copper, could be around November, December. And it got into a chart pattern that led to this sharp spike up. And it's just that I guess that the bear market from 2011 to last January, February was immense. You had price lower than $2. We had the rebound up until mid-year. Then for recent, people just got on board. It's part of it came in the last 2 weeks before the election, strong rally. So it was anticipating a Trump win, and of course the Trump win is that he's going to re-emphasize the older industries in the U.S., and hopefully production will come in. So, but new industrial production in the U.S. or reviving industrial production in the U.S. It may be offsetting industrial production in other countries. So it's a market phenomenon tied to the election, and we're watching for it to get overbought in here.
And Bob, before we go, we have a question from Chris Barsky. Trump's election promises, if all implemented, will add 2 to 3 trillion to the annual deficit in the U.S. Would this crowd out a lot of private borrowers, driving interest rates even higher? And what's going to stop the Federal Reserve from monetizing Trump's enormous shortfall and take their balance sheet to 10 trillion in 2 to 4 years? Will it be a new normal of monetizing government deficits so they don't have to worry about them? Is Trump attempting a Reagan 2.0 on steroids, but for various reasons it will not work, just like Reagan's trickle-down economics didn't? Reagan doubled the accumulated debt by the time he left office. Are we going to see something even worse by the time Trump is done?
Yeah, good questions, but the projecting deficits from policies that have yet to be implemented, it sounds like more of a political move. And of course, anybody on the budgeting and deficit side and the OMB, Office of Budgetary Management, whatever it is, they're all a bunch of Democrats. So this is impossible to do. Well, one of the things that could happen is that with much lower tax rates is certainly going to stimulate investment. And we also know from the Laffer curve that the lower the taxation, the higher the taxation rate, the less overall revenues you bring in, and a lower taxation rate can bring in more revenues. So I think this is pretty woolly stuff. And then also to go back to Reagan, that was a well thought out campaign. They were going to go to a gold standard to curb government expenditures, lower tax rates, and they were really going to trim back government expenditures. But he was facing a Democrat House and Congress, so that was not going to happen, so it didn't. But the parts that came in, lower taxes, ended up, being larger deficits. But this time around, it would be like Mrs. Thatcher's majority in England in the 80s, is that the majority in a parliamentary system gives you a lot of power, and she was able to privatize things terrifically, and this was thwarted. Reagan's plans for this was thwarted by the Democrats, but in this case, the Republicans have the strongest position politically since the 1920s, and the one I saw with the, we'll just leave it at that. So it's better than what it would have been with the Hillary administration, which would have been a greater intrusion by government with absolutely no limits whatsoever. So I look at it as a big plus, and can't get worried about deficits. The markets will trend for that. Interest rates are heading up anyways, so that's just on market forces. But it's great to get the question, Chris.
Bob, thank you so much for chatting with us, and have a great weekend.
You too, and we'll look forward to talking next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. You can forward questions for Bob to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.